In the heart of Houston, rising toward the Texas sky with the cold, unyielding precision of steel and glass, those majestic towers stood at the end of the 1980s as more than just a corporate headquarters. They were a secular temple of American corporate intelligence and the absolute pinnacle of modern capitalism. The story of Enron began in 1985 with the merger of Houston Natural Gas and Internorth, a union that at its inception was a straightforward, perhaps even mundane, energy utility enterprise. Their business was the tangible work of moving natural gas through a vast network of pipelines from one point to another. However, the immense ambitions of Kenneth Lay and the radical financial vision of Jeffrey Skilling fundamentally reconfigured this static landscape. With Skilling's arrival, Enron performed a radical surgery on its own identity, abandoning the heavy, rusted physical assets of the old world, the pipes, the plants, and the infrastructure, to transition into an asset-light model based entirely on intellectual capital and complex financial derivatives. They were no longer merely selling an energy commodity. They were trading the future probable price of energy, the risks associated with unpredictable weather patterns, and even the bandwidth capacity of the internet, as if it were a high-speed financial asset. Skilling wanted to turn Enron into the Goldman Sachs of the energy world, and for a long, shimmering moment, he succeeded. The corridors of the company were haunted by the brightest minds from Harvard and Stanford, young men and women who proudly called themselves the smartest guys in the room. To them, ethical boundaries were merely obstacles for the weak, and profit was the only objective reality that mattered. Being named America's most innovative company by Fortune magazine for 6 consecutive years only fueled this collective narcissism and the dangerous sense of invincibility. Inside the company, the brutal rank and yank performance system pitted employees against each other, ensuring that the bottom 15% were fired every year, creating a loyalty forged in absolute fear. In this environment, the only way to survive was to inflate the numbers by any means necessary. The foundations of Enron's inevitable collapse were laid by its greatest perceived success: mark-to-market accounting. This system allowed the company to record all the potential profits expected from a project over the next 20 years as revenue on the very day the contract was signed. It was a grand illusion where virtual, projected money was presented as immediate realized profit. If, in the real world, a project failed, or the expected cash never materialized, Enron simply resorted to even more complex manipulations to hide the loss. As these virtual gains grew, the company's real debt began to expand at an astronomical rate. It was at this critical juncture that Chief Financial Officer Andrew Fastow's network of Special Purpose Entities, or SPEs, entered the fray. Fastow created hundreds of offshore shell companies with cryptic names like Chuco, Jedi, and LJM to conceal the billions of dollars in debt that were rotting Enron's balance sheet. These structures were the black holes that swallowed Enron's failures. Debt was moved off the official books and into these shadow companies, and in exchange, Enron's own stock was put up as collateral. It was a financial version of an Ouroboros, the snake that eats its own tail. As long as the stock price remained high, this fragile system functioned. But the moment the market wavered, the entire empire would transform into a bomb waiting to detonate. During the California energy crisis of 2000, the moral bankruptcy of the company became public as Enron traders artificially created power outages to drive up prices. Strategies with code names like Death Star and Fat Boy were used to play games with the energy supply of an entire state. Recordings of traders laughing about robbing elderly grandmothers revealed that Enron was no longer just a greedy corporation. It had become a systematic machine for financial crime. The illusion began to shatter in the autumn of 2001 when the dot-com bubble burst, and it became clear that Enron's ambitious internet ventures were yielding no real profit. The sudden and unexplained resignation of Jeffrey Skilling in August was the first serious signal of doubt to the market. He claimed personal reasons, but he was in fact the first captain to abandon a ship he knew was taking on water. A few weeks later, Vice President Sharon Watkins sent a famous anonymous memo to Kenneth Lay that laid bare the terrifying reality. I am incredibly nervous that we will implode in a wave of accounting scandals. On October 16th, Enron announced its first official quarterly loss in years and admitted that shareholder equity had vanished by $1.2 billion in an instant. This was the beginning of the abyss for investors. As the Securities and Exchange Commission began its investigations, it was discovered that Arthur Andersen, one of the world's most prestigious auditing firms, had destroyed thousands of documents related to Enron. This was no longer just the failure of a single company. It was the collapse of the entire system of corporate oversight. Throughout November, Enron's stock went into a free fall. The value that once stood at $90 plummeted to just a few cents. On December 2, 2001, Enron officially declared bankruptcy. This was not just a collapse of numbers. It was the destruction of 20,000 jobs and the evaporation of $2 billion in pension funds for thousands of ordinary people who had spent their lives building those savings. While company executives had secretly sold off their own shares in time to pocket millions, rank-and-file employees were forbidden from selling theirs. It was the greatest and most ruthless betrayal in corporate history. The subsequent trials of Kenneth Lay and Jeffrey Skilling showed the world how America's most celebrated leaders had become common criminals. While Lay died before he could be sentenced, Skilling was condemned to a long prison term. What remains of the once mighty E? The lessons left behind in the ruins of Enron still stand as a warning sign in the foundation of the global financial system today. This collapse taught us that where there is no transparency, corruption is inevitable, and no amount of complex algorithms can replace basic integrity. When corporate governance mechanisms are merely an imitation of oversight, when auditing firms prioritize their clients' interests over the public good, and when leadership focuses on short-term stock prices over ethics, disaster is only a matter of time. While laws like the Sarbanes-Oxley Act were passed to tighten accounting standards, the true lesson of Enron lies deep within human psychology. It is a tragedy born of intellectual hubris, the arrogance of believing one knows everything, and a profound moral blindness. The fact that the word integrity was etched into the company's mission statement while having no connection to its reality proved that a company's culture is far more important than its official slogans. Enron was more than an accounting fraud. It was a cultural meltdown. It is the story of modern man overreaching, believing he can manipulate the uncertainty of the future through financial games. Today, that glowing E no longer shines over the Houston skyline, serving as a bitter reminder for every investor, executive, and citizen. Even the tallest buildings will crumble into a pile of dust in an instant if they are not built on a foundation of honesty. The truth, no matter how deeply it is buried, eventually finds a way to see the light, and that path often leads through great destruction. Every business leader must remember that the shortcut always leads to the longest fall.